Hey friends, welcome back to the channel. Now, the world of investing is huge and it is hard too. It takes time and patience to learn about and kind of master some required skills too. But of course, as a student and teenager, we don't always have that time to learn about investing. And when we do, we don't know where to start, right? And it quickly ramps up to become an overwhelming duty. So in this video, we'll talk about everything you need to know to start investing today, from why is investing so important, what to look for, what to avoid, and how to even learn more about it at the end of this video. This is Investing 101. Let's talk about it. Alright, first, why do we need to invest today? And why is investing so important? So the main ultimate goal of investing is to make more money later with what you have today. And this is cool because it kind of acts as an extra income to your existing one, and sometimes it can even replace it completely. The other benefit of investing is to fight against inflation. So inflation happens when we inflate the money supply in our country. The bank simply decides to print even more money, so the value of the currency will simply drop. Not significantly, right, but in the long term it will significantly hurt our portfolio and hard-earned money too. Just take a look at this graph. It represents the buying power of $100 from 1923 to 2023. And in 100 years, our $100 is now worth $5.41 today. And the dollar had an average inflation rate of 2.91%. So the goal of investing would be to at least reduce that loss, and if possible, make some returns from it. And remember that 2.91% inflation, because it's gonna be useful in the next few minutes. Now, investing comes with drawbacks too, which are of course the risk linked with it. So as investors, we want to minimize our risks while maximizing our gains. I'm not saying zero risk at all and unlimited money with market hacks and tricks to beat other people, no. But for some reasons, investing doesn't have to be that complicated, and it can in fact be easy to understand. Now, with that in mind, what would be the best, safest and easiest investment if you had to own one forever? The goal here is to reduce the possibilities and choices as much as possible. And in this world we have tens of different investments: stocks, bonds, mutual funds, ETFs, options, cryptocurrencies, commodities, real estate, and even Lego. Yes, Lego. So remember, inflation was about 3% a year on average for the past century, right? Now, we want to find an investment that does at least 3% a year and more, if possible, while minimizing risk and maximizing earnings. Well, for now, the safest investment would probably be bonds. When you buy a bond, you're essentially lending your money to a business or the government. It could be for a 5 years period, 10 years, 15 or 20 years period. And every year you get something called interest, which can vary from 1% of your portfolio to 4 or 5%. And then you get back your initial investment at the end of the period. So you end up with your initial investment plus the yearly interest. In the US alone, you can expect a 10-year government bond to give you roughly 3.50%. And this is cool because it would beat our 2.91% inflation rate. And every single year you know exactly how much the government will give you back. So it is kind of like a safe and predictable investment in the future. Now, there is one better investment known to the world and still pretty exciting and safe. This is called the S&P 500. This is an index fund that represents a basket of the 500 biggest US companies. They are listed by market capitalization, so we first have Apple, Microsoft, then Amazon, Nvidia, Google, Tesla, etc. The bigger the company, and the better it will be ranked. And this index constantly evolves over time. Stocks have been added, removed, sectors also have been changed. And for the past 100 years, from 1923 to 2023, the S&P 500 increased by around 10.49% a year on average. That clearly beats the bonds and inflation itself, and historically, no one ever lost money when investing in the 500 biggest US companies. And by the way, these companies alone represent 80% of the total US market cap. So that means if the S&P 500 loses 50% of its value or more, all of the companies in the US would probably lose as much, if not more. So actually, we cannot invest directly in it, since it groups 500 biggest US companies. It would be pretty time-consuming and boring to buy every single stocks that shapes the index. But we are looking for a passive way to make money. That's why this guy comes into play. His name is Jack Bogle. He passed away in 2019, but he also left behind a legacy of innovation to the world of finance today. And he basically founded the Vanguard Group, a company to manage index funds. So even if he didn't create the S&P 500, he created a way to track it and replicate its performance. You can go on their website and invest as low as $10, or you can open a broker like Robinhood in the US or Trading 212 and Trade Republic Republic in Europe. And this brings us to the number one behavior when it comes to investing in the stock market. Investing is in the long term only. And there are a few great reasons to explain this. Well, first, investing in the short term is way more risky because investors like us are competing against traders, which also buy and sell stocks, but in the short term only. So take a look at this. Traders have an investing horizon of between roughly 1 day to 1 year, maybe 2. They simply try to go with the trend, but investors have to think in at least 5 to 15 years. So think of it like this. Investing your money is like throwing it away for 5 to 15 years. You have to accept that it can go down as much as it can go up. And you're most likely to be right in the long term. That explains why in 1 year, Apple looked like this, a random mess which goes up and down every day without clear directions, right? But for the past 5 years, Apple went significantly up. I'm not saying that you should put $1,000 in Apple right now, but it shows that investors believe in Apple in the long term, no matter what is happening to the economy and Apple itself. For example, the current inflation rate compared to last year is now 6.04% in the US. This is huge, right? But when you think about it in a 100 years time frame, things appear to be better than we think they are. Despite decades of crises, wars and unpredictable events, inflation is on average 2.91% a year only. And as teenagers and students, we can fully take advantage of something called compounding, or the snowball effect. Compounding happens when you reinvest your earnings. So for example, let's say you invested $100 in 2022, and your investment went up by 12%, which is what you could expect in the long term in the S&P 500. You now have $112. Then next year, $125.44, then $140.50, etc. Every year your portfolio will grow because you will receive dividends from the 500 companies you now own. And reinvesting them in the S&P 500 will make you even more money, and so on, until pretty much forever. Since we are roughly 18 to 25 years old, compounding will be even better in the next 20 to 30 years. There is just one drawback to it. Compounding takes time. I mean, a lot of time. You simply cannot expect to double or triple your investments in 1 year alone. Here, your best friend is the S&P 500 since it gives you a high return with really low risk. But your biggest enemy here is time. Alright, next, stocks are unpredictable. Here are 7 screenshots taken every month from the videos I've made in my series called Invest With Me, which is pretty straightforward. Each month we can invest together a few $100s in stocks that I carefully choose. And as you can see, none of them look like the others. Every time something made their price moved up or down. And that is something you can hardly control. I mean, not at all. The price of a stock has nothing to do with its earnings, or in other words, it is the price versus the value, and not the price equals the value. And once we get that, we will understand at least half of investing. Sometimes the stock will go up because more and more people think and see that it went up, so they think it will continue to go up. Sometimes the company will buy another company, so its price will move again, or layoffs that are both a good and bad sign for the company and its price. So if there is one thing I learned from the past 6 months, it's that the price you buy does not reflect the real or intrinsic value of the stock. And good news, that also works with ETFs, since it is just a group of multiple companies. So we should all invest a small amount of our income consistently and long enough so that it compounds and grows over the long term. And this is simply called dollar cost averaging, so continuously invest no matter what the S&P 500 is doing. This technique allows you to smooth your purchase price, whether the stock is going really up or completely down. For example, I invest $500 a month, no matter what is happening to the economy, so every year that equals to $6,000. Alright, now we know what to do, how to do it, and when. So invest every month a portion of your savings into the S&P 500 in the long term without interruptions. Right, now it is also important to know what not to do. I have built a portfolio of exactly 20 stocks for the past 7 months. I've made a whole video about it right here if you're interested, by the way. And if there was only one thing to remember and share with you, is that you can try as hard as you can and as you want to beat the market by yourself. It is nearly impossible to succeed. You have to read every annual report possible about companies that might not even interest you, compare sectors, stocks, and diversify your own portfolio. Also read books and educate yourself as much as possible every single day. And then read the annual reports again because you might have missed something important to finally not beat the market. Instead, you should focus on the S&P 500 only. Now, there is one last thing I wanted to talk about before the end of this video. It's this whole story about S&P versus S&Me, which is actually a pretty interesting debate around education. We have the possibility to invest, let's say, $10,000 in the S&P, which would give us around $1,000 after 1 year. Now, there actually is a better way to use those $10,000 shares and earn even more money. Because investing is simply putting our money to work and having more after it, right? But stocks and shares are only one way to make it happen. We can also buy courses to learn new content and skills and maybe expect a better return on investment on it. Especially if you are young and want to learn more about new things that might be interesting to you. For example, it could be a YouTube course to learn about videography, storytelling, and how to systemize your workflow. And if you have enjoyed this video and want to learn more about investing itself, you can check this video right here where I talk about investing Apple versus buying Apple, or this one right there where I invest in front of you each month. Thank you so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.